Hello, and welcome to today's webinar, Rising Insurance Rates in 2021, How You Can Take Control and Manage Costs. My name is Paul Rasta, and I'm Executive Editor of CPE. We are delighted to have all of you in the audience with us today. For the next hour, we're going to explore solutions to one of the biggest new challenges that has emerged this year for owners, asset managers, and property managers. Because of a steady stream of large-scale catastrophic claims, it's getting more difficult to find insurance carriers which are willing to underwrite risk. That means two things. It's harder to find coverage, and your premiums are probably going up next year. This trend, which risk management professionals call a hard market, is affecting commercial assets and residential properties across North America. The good news is that you can do something about it. Today, we're going to share some strategies that you can use to help you reduce risks and manage insurance costs. To help guide us through this challenging landscape, we've brought together three experts from Hub International, the risk management and insurance advisory firm. Let me introduce our panelists. Dave Barthel, Vice President and Risk Services Manager for Hub International's Western Canada Division. Lindsay Shapiro, a risk consultant at Hub International's Risk Services Division in New England, and Chip Stewart, who is Hub International's real estate practice leader. It's great to have all three of you with us. Thank you for making the time today. We're going to start today's program with some background about why insurance rates are on the rise and how you can manage your approach to insurance coverage. And then our experts will provide a variety of strategies for managing costs through a comprehensive risk management program. You're going to hear much more from Dave, Lindsay, and Chip in just a moment, but first let me just touch on a couple of quick housekeeping items. This is an interactive program, so let me encourage all of you listening live to submit your questions for our panelists. And of course, the earlier you can send them in, the better chance that you'll get an answer in real time during the broadcast. We've set aside about 15 minutes at the end for Q&A, but if time runs out before we get to your question, or if you prefer to get in touch confidentially, Chip, Dave, and Lindsay will be happy to follow up with you after the program. Also, this webinar will be archived and we'll be sending a link to everyone who registered so you can hear it again and tell a colleague. Well, we've got a lot to cover today, so let's dive right in. To start things off, we're going to hear from Chip Stewart about how we got here, why it's been happening, and what you should expect in 2021. And Chip, let me turn the program over to you.
Well, thank you, Paul. Appreciate it. And I think today what we want to do is get across to you as to what you can do to help mitigate this hard market. What is a hard market? Well, it's a term that's been used in the insurance industry for years. A hard market is when it becomes hard to place insurance, where insurance companies start to pull back, and that means less competition and rates go up. So what happened back in June 2019, we started to see the hard market start to materialize, and that resulted in insurance rates going up, deductibles going up. Fewer insurance carriers were willing to participate, and then we saw some gaps in coverage start to emerge, especially within 2020. But what really happened was in 2017 and 2018, the insurance companies started to see some claims, and we'll talk about that in a few minutes. And the claims started to mount, and they held on, tried to keep their market share. And then finally around June of 2019, no longer could they hold on, and they started to increase rates, and we started what is a hard market. Next slide. So what should you expect in 2021 for insurance premiums and terms? You can expect more of the same that you saw in 2020 and 2021. I just spent 2 weeks talking to most of the major insurance companies, and they all plan on rate increases for 2021 in a hopes to become profitable again. However, that doesn't mean that you have to take every single rate increase that you're given. There are things that you can do to mitigate that. One of the things that drove the market up this last year was COVID-19. And a lot of people realized that after all the court hearings and so forth, that the virus really is not covered by standard real estate insurance. They've tightened up their clauses for 2021, but most of the courts have come down on the side of the insurance companies that they really did not charge premium. They did not intend to cover virus, and many of the carriers actually had a virus exclusion, but they still had to pay for defending themselves, which increased rates. The big surprise, I think, to a lot of people for the first time in probably many years was auto, D&O, umbrella all went up at the same time. and they went up at rates that are, that sting 30%. The auto liability losses really started to mount in about 2019 when we saw the first increases, and they're going to continue again in 2021. Umbrellas used to be an umbrella. They used to be sitting on top of your general liability program, and nobody really paid attention because you just paid a few $100s and there it was. But now they're getting dragged into all the lawsuits, and they call that social inflation. The jury awards are starting to drag all the umbrellas in. So now they're starting to charge like they are the primary general liability. Insurance companies have started to pass on portfolios that they see are high risk or have habitational risk in it. Habitational risk for the insurance companies in 2017, 18, 19, and 20 have not been profitable at all. So they're trying to get away from that. Now, if you have some habitational risk, maybe 10 or 15, 20% of your whole portfolio, most of the insurance companies will still look at you and consider you as a risk. But if you're over those percentages, they're probably going to back off and just decline. And then we're also seeing lower limits on blanket limits. What is a blanket limit? A blanket limit was, oh, I have $100 million for all my locations. I don't really have to worry. It's great sleep insurance. Well, now, yeah, if you had a property that was worth 20, but you had a blanket limit that was worth 100 million, you didn't really worry about what the valuation was on your $20 million property. Now you got to worry because they're trying to take the blanket limits away or charge their way out of them. In other words, they're going to increase the premium so much that you're going to say no. Let's go on to the next slide. So what's really driving these rates up? What happened? Why did this all of a sudden start happening in 2019? And it's water damage, water damage, water damage. Everything starts with water damage in real estate. If you've owned real estate, you've probably had water damage claims, and they can come from a lot of different things. Natural catastrophes, climate change, California wildfires. We had a lot of homes in California that were decimated by wildfire. Riots, civil commotion this year, 2020, actually contributed greatly to our market. Administrative costs, defending against pandemic claims, previous lower deductibles that they had, where they were charging $5,000, $2,500, $10,000, and now they're having to pay on those low deductibles. They have reserves that they have to set against the bank to make sure that they've got the money in hand ready to pay. So they're having to do big reserves. And then the reinsurers. A lot of the insurance companies behind the scenes, you don't really see it, but the reinsurers are the ones that are reinsuring some of your portfolios. And their profitability declined in 17 and 18, and they remained competitive for a while. But as I said, in June 2019, they stopped, and now they're charging more back to the insurance companies who pass that rate on to you. Next slide. So we talked about water losses. It accounts for a substantial part of all the claims. And the frequency is as follows: water from flood, water, sewer backup, and fires. Don't forget, when they put out a fire, they're causing water damage. And then freezing pipes that break and then spread water throughout the properties. And year-to-date claims by severity so far this year was flood, hurricane storm, surges, riot, civil commotion, wildfire, and hail. So you start adding all these things into 2020, and that's not good. That either puts further pressure on the market. And that's why I say that I think in 2021, most of the underwriters have edicts to try to get rate increases on real estate portfolios. But it doesn't have to be that way for you. Next slide. You need to think about it now before your renewal, and don't think about it 2 weeks, 3 weeks before your insurance comes up. There are certain things that the insurance companies want to do. If you've ever gone out and tried to get a loan, or you're trying to sell debt, think of it that way. The insurance companies pretty much want to be told how is your account, your portfolio going to be profitable to them. And that's your insurance broker's job, is to show that you are best in class, that you are unlikely to have claims, that you do all the right things. So the market right now is very cyclical. We have had really no hard market since 9/11 in 2001. And the last couple of years now, we're in a cyclical hard market. It will come to pass, but the insurance companies have to return to profitability before that happens. So we don't see a whole lot of change going on based on my conversations with all the insurers for the next year or so. One of the things that they're looking at is deductibles and the quality of your submission. Deductibles used to be pretty low, and now they're looking to get out of those nuisance claims. What's a nuisance claim? Well, go back to water damage. Water damage claims are nuisance claims. They're usually $3,000, $5,000, $10,000. They have to send the adjuster out. There's a lot of paperwork. They're wanting to get rid of nuisance claims. So if you've had losses, go backwards, look at your deductibles, and if you set your deductible at $25,000 or $50,000, because your claims are all under that, you're going to see some relief in your premium rates. The quality of data in your submission, that is up to your insurance broker, your agent. You need to have good information. Now, what does that entail from you? Loss of rents coverage. Is your rents on an annualized basis up to date? A whole lot has taken place during COVID. Maybe the rental values are down. Maybe the rent is down. Well, you need to actually take those values that you declare to the insurance company down. That will actually release some pressure off your rates. Lower rental income means lower insurance. So quality of the data. What about replacement cost on your buildings? When's the last time you really looked at it? I talked earlier about blanket limits, and those were great. But as those start to fade away, and each property is going to be paid out on its own replacement cost at the time of loss, what is the right replacement cost on your building? If it's too high, you're paying too much. If it's too low, you're underinsured. So how to navigate all these claims? There are things you can do. Deductible buy downs. You can actually take a deductible and buy it down from what the insurance companies quote you. You can actually get another insurance company to do a buy down for you. That's if you have some type of contractual obligations where you have to have low deductibles. There's parametric programs available, probably not for you, but they are available, and ownerships and boards want to hear about these things. But it's basically gambling. It's not an insurance policy, so to speak. It's if an event happens, and then the insurance company has to pay out on it. Sounds like something from Vegas. And then there's participation by you as the insured in buffer layers. Whereas you may have different insurance companies participating in 2021 on your program, there may be a layer or a piece of the insurance that is just so expensive you could pass. And we call that a buffer layer, where you self-insure that layer. And you can save a lot of money by doing that, but you're also accepting risk. Next slide. Well, if you're into taking screenshots, this is the time to do it. There's a lot on this page, and I'm not going to go through it all. But you are going to see some changes in the insurance policies, and these are the things to watch out for in 2021. And I want to make it clear that just because I'm saying 30% does not mean you're going to get a 30% increase, but that's what the target is for most of the insurance companies, is 30%. So what you have to do is take a look at your coverages, which is this slide. You have to look at your values, and you have to look at your type of program as far as options go: layered, shared layers, quota shares, things like that might save you some money. So if you take a look at some of these capacity issues, larger portfolios are probably going to need maybe 3 or 4 companies. So if you've got $1 billion or a $500 million portfolio, you may want to have 3 or 4 different insurance companies actually participating 25%, 25%, and 25% on your portfolio. Now, this could be difficult in a claim, but hopefully your insurance broker knows how to do that type of quota share program. Or you might be layering the program where one carrier takes the first 5 million, and the next carrier takes the next 10, and the next carrier takes the next 20. All ways to save you money. Watch out in your inbox for non-renewals. Insurance companies are, in most states, have to send them out. Otherwise, they can't really change the insurance much. So as a rule, they are sending out notices of cancellation. And don't panic, as we say, but you have to take them seriously, because it does get them off the hook and allows them to make changes to your policies. And be careful, your lenders may panic, and you have to let them know that you've got it under control and that you're going to have a good renewal, so your lenders don't get anxious. Quality of data, we talked about that. Replacement cost, rental values. Do I have the right replacement cost for 2021? Not for 2010, but for 2021. Where do you get good replacement costs? From a good contractor. They can tell you what it would cost to rebuild your building per square foot. You know what the square footage is, multiply it out. Coastal areas, earthquake, hail, windstorm, flooding, you can actually have modeling done as to what the modeling will dictate as far as your limit goes. In other words, if you're in a tier 1 in Texas for windstorm, what would be the probable maximum loss for your property? Your insurance broker can help you with that number, and that may be beneficial to a lower rate premium from your insurance company. You're going to maybe need to have separate policies for wind, for earthquake, or for flood. Those can be sold a la carte. And then I'm not going to go through all these classes and so forth, but if you look at some of the big ones, earthquake sprinkler leakage, we're actually seeing that just disappear. In other words, they don't say a whole lot about it, but they're taking it out of policies. So you may have to fight to get that one back in. We talked about replacement costs on your policy as far as the valuation of your properties go. And one of the things you might want to look for is a co-insurance penalty. And what that says is if you actually did not get your valuation right on your property, then they actually will have you participate in the claim. So if you look at all the rest of these things, the blanket limits, liability per location, these are all things that are going to be on the table for next year for real estate. And you need to be ready to talk about them. The biggest thing to take home today about what you can do is to have a business continuation plan. In other words, what are you going to do if you have a loss at one of your properties? How are you going to stay in business with COVID? How are you going to make changes to your property so the tenants still stay in place? And that's what the insurance companies want to hear, that you are going to save them money because you're going to have fewer claims. And that will help you with your premiums for next year, 2021. Now we're going to turn it over to David. And David Barthel is our manager for the Western Canada for Risk Services Division, and he specializes in these types of topics. David?
Hello, everyone, and thanks for attending today's session. My name is Dave Barthel, and in this section, I will address actions that property owners can take with the support of third parties to help reduce risk, prevent insurance losses, and manage your properties in a hard market. As Chip mentioned in the summary, one of the reasons for the current hard market has been the result of poor financial results from an increased number and cost of claims. As insurance carriers seek to be more selective in their underwriting process, they're looking to allocate their resources to those organizations who have a solid risk management plan in place. But to begin our discussion on risk management, we first need to define risk. Risk is any kind of hazard that can negatively affect your property or operations. What those risks are depends on your organization, your property, and how well you manage those hazards. Factors that affect risk include both the likelihood that an event will happen and the severity or impact it will have on the property. Both likelihood and severity can be managed. Some hazards have a higher likelihood of occurring, and others have a higher severity to your operations. A good risk management plan identifies your organization's risk and manages them by reducing the likelihood, severity, or both. So a critical factor for property owners is that preparation, a solid risk management plan, and working closely with your agent or broker will put your organization in a position to be better prepared to weather the challenges of a hard market. One of the first steps to take in managing your organization's risk is to identify what those hazards are, which could negatively affect your properties. If you do not know all the hazards which could affect your property, that needs to be your first step in improving your risk management plan. As property owners should consider having a third party conduct a risk assessment of their facilities, whether it is your broker's risk service department or another third party. Conducting such an assessment allows you to identify potential risks that you may not be aware of. Knowing the hazards that can affect your business can help you take action to mitigate the risk and reduce the potential that those hazards will lead to incidents which could negatively affect your property, your business operations, or your profitability. Improving your risk management plan by conducting an assessment not only decreases the chance that a hazard will result in a loss event, but also communicates to insurance carriers how prepared you are to weather an event were one to occur. An additional point to consider that Chip already talked about is the need for regular appraisals for your property. Knowing how much it would take to rebuild your building if an incident were to occur is fundamental to planning for that event. It has been widely reported in the insurance industry that a high percentage of buildings in North America are underinsured, meaning that there is a separation between what a building is insured for and what it would actually cost to rebuild that structure if a total loss event were to occur. This could mean that if your business were to sustain a total loss event, that you could be on the hook for whatever gap exists between the current replacement cost and what the actual reconstruction cost would be. Changes in construction costs vary greatly throughout North America, and having an appraisal done provides you with the confidence to know that your property is adequately insured. Now, do you have to have an appraisal done every year? Absolutely not. But if you do not know the last time you had an appraisal done, it's probably time to consider having one done. Having an appraisal done every 3 years is probably a good guideline, depending on the property and location. Water damage has been one of the largest driving factors in increased costs in the insurance industry today. Properties across North America have seen a significant increase in the number and severity of incidents due to water damage. And by water damage, we do not only mean flood events due to storms or flooding events, but in fact, the majority of water damage claims and costs are related to flooding events due to water loss events within buildings, including broken or leaking pipes. For a property owner, this means being proactive around managing the risk of water damage. Do you know if your property is in a floodplain, and do you have a plan to respond to that event to protect your property? Do you know what type of plumbing system is in your building? Has a plumber completed an inspection to determine if there's any potential issues you should be aware of? Most importantly, does your property have a water damage mitigation plan, which would allow you to respond quickly to a water damage event and make sure that it is controlled quickly, reducing the severity of the event and minimizing downtime? If you do not plan for an event, it will lead to more damage, longer downtimes, and increase the potential for mold or other effects of water damage to take hold. Another point to consider is your location when it comes to flood exposures. Something that should be strongly considered, especially if you're moving your business or opening a new location. When you are selecting a location for your business, the cost of your insurance may not be top of mind. But if you want to reduce your long-term costs when it comes to insurance, you should talk to your agent about locations you're considering if you plan on moving your operations. Insurance carriers use computer modeling to identify those areas which may be more likely to be impacted by flood events. And as such, those locations may be impacted by higher insurance premiums or may simply be harder to gain insurance coverage altogether. We recommend you know how your location can impact your insurance coverage before you move into that new office or warehouse space. Water damage is one of the most common hazards businesses have to plan for, but what about other hazards? As mentioned in the beginning of the section, knowing your hazards and how it can affect your property is critical for planning and creating your organization's risk management plan. Is your company prepared for and know how to quickly respond after a fire event? How prepared is your company to respond to an earthquake, windstorm, or civil unrest event? Was your organization prepared for a pandemic and how it would affect your operations at the beginning of 2020? Most likely no, but there were businesses who had thought of how a pandemic would affect them and they were able to pivot their businesses faster than others, putting them at a potential advantage by minimizing some of the negative impacts to their operations. Our organizational resilience team has worked with clients to prepare for and respond to incidents ranging from this year's global pandemic to workplace violence incidents and other crises. This team continually reiterates the idea that planning for an incident, no matter how unlikely, better prepares your organization to respond to all types of risks. Taking action now not only prepares your company to respond to an incident, but also communicates to the insurance industry how important risk management is to your company. Business continuity has become a critical component to long-term planning and risk management. You may not feel you need to plan for loss events, or you may not even want to. But many insurance companies are now looking for businesses to have a plan when it comes to the continued operations of their business after a potential loss event. When your business uses third parties to conduct work on your behalf, or have them come onto your property to conduct maintenance or other work, those companies increase the risk for your property and your operations. Are you confident that all third parties that come onto your property employ the same kind of risk management planning that you do? Do they have the right level of insurance that gives you confidence that their errors are covered? If that company does damage your property or takes action that leads to a loss, can you be confident that they know how to take action to mitigate the potential impact of that loss? When your company is looking to work with a third party, the cost of their services should only be one component of your selection process. Vet all third parties by asking each vendor to provide you with a certificate of insurance, and potentially request to be listed as an additional insured on their policy when it is appropriate. Consult with legal counsel when entering into complex contracts, and ensure that adequate indemnification language is included in your favor. Simply put, don't end up paying for someone else's negligence. If the property that you manage or own is a residential or commercial strata, we would also encourage that you discuss bylaw reviews as a means to mitigate risk. Many stratas have not had their bylaws reviewed, which can result in significant exposure to costs that were not anticipated. We recommend that legal counsel reviews bylaws every 5 years to ensure that they do not present unwanted exposure for the property or organization. All bylaws should also address changes in legislation, such as the legalization of cannabis in Canada and some U.S. states. Other areas that bylaws should be clarified is in regards to the permission of short-term rentals, smoking, how and when renovations are conducted. And with that, I will turn it over to my colleague, Lindsay Shapiro, who will go over additional steps to mitigate risk. Thanks, Lindsay.
Thanks, Dave, and hello, everyone. My name is Lindsay Shapiro, and I'm going to review with you the last portion of this presentation. Starting with this next section, we'll identify some areas of risk that can be addressed by property owners or managers without the assistance from other parties. For instance, self-assessment. One easy and proactive way to manage risk for your property is just to stop and take a look around. Conducting regular self-assessments of your building with a checklist can help you identify hazards prior to a loss. You may discover issues that could be addressed through regular maintenance before they become a larger problem or could present a risk to the continued operations of your facility. And documenting this process of a self-assessment supports your organization's risk management plan and can reduce your costs. By identifying a minor issue now through a self-assessment may lead to some minor maintenance costs, but not knowing about it until a major event occurs can substantially increase costs and the likelihood that your ability to continue normal operations could be negatively impacted. So self-assessments are a great tool. They also provide insurance carriers with the confidence that your risk management and the maintenance of your property is important to you as a building owner or manager. And risk consultants with carriers and brokers like Hub can help support these efforts by participating and or providing supporting resources such as sample checklists or suggested areas to focus on. Building maintenance is fundamental for not only the operation of a building, but is also something underwriters are looking at in their review process. Properties should have regular inspection reports to communicate what building systems are in need of repairs or replacements and when. And these kinds of reports should drive regular preventative maintenance, as well as larger system upgrades, such as the replacements of roofs or mechanical systems. And property owners and managers, particularly of older buildings, should be aware of building systems which present higher risks for losses. So aluminum wiring or poly plumbing and other systems and components that increase the potential frequency or severity of loss. These should be addressed through phased replacements and upgrades or by some other means to reduce that risk. Housekeeping is similarly important to document its management, ensure there's no exposure to potential losses. So, overall maintenance shouldn't be put off, but should be appropriately financed by building owners, because when it's put off, the costs can increase or lead to losses, which can have major impacts on insurance, and getting issues fixed early on can reduce the potential that losses can negatively impact your operations. Claims management. So in a soft market, extremely low deductibles can lead to instances where insurance claims have been made for relatively small loss events. And we've seen a number of incidents where businesses in the soft market were making a large number of insurance claims for relatively small amounts of money. And in a soft market, this can make sense. However, in a hard market, those same businesses may be seen as not having a strong risk management plan and simply reliant on insurance to address maintenance issues. So proactive risk management around claims means communicating with your insurance broker to understand how claims can be managed and how you can put your business in the best light to ensure you're getting the right insurance coverage for the right price. And now, depending on your organization's comfort with risk, this may mean considering larger deductibles if you have a strong risk management plan in place, but definitely talk with your broker to see what works best for you. In this final section on communicating better information, we'll review some tips on how to differentiate your business in a hard market. So gone are the days of supporting an underwriter with just an address, a basic occupancy description, and COPE data. We're in a time where the more detail, the better, and you'll want to make your property appealing to underwriters. Providing information that tells the whole story of your company, your facility, detailing data which highlights risk management and claims prevention. It's really important to document and communicate those actions to insurance carriers in order to help your broker to negotiate the best possible coverage for the best possible rate. And documentation may take the form of written reports or other forms of communication to ensure that your risk management efforts are reflected in your insurance policy. Overall, active risk management demonstrates that awareness of exposures and the willingness to proactively manage those risks, which is very attractive to underwriters. So how do you tell that story and differentiate yourself? You have the opportunity to provide detailed data which highlights the engagement of your property, your company in managing risk and preventing claims. And this is what will make your business more attractive to insurance carriers by presenting the best story of your risk to drive competition between the insurance carriers to motivate them to offer the best rate. And when you have underwriters that have a stack of submissions sitting on their desk, they're going to be attracted to the risk or the property, the company with the most complete, easy to read and detailed information. Impact on insurance. So taking all of what we have discussed today into consideration is really fundamental to be successful in a hard market. Today's presentation was intended to ensure that property owners can manage their insurance in the tough market and in the midst of a very, very tough year for businesses throughout North America and beyond. And we hope that the tips that we offer today will help you reduce your risk, reduce your potential claims, and allow you to have a better insurance submission, providing you with an easier renewal or binding process. And two final takeaways, insurance can be complicated, but you can talk to your broker about your options, and Hub can help if you choose to partner with us. And secondly, and most importantly, I think, you can manage your insurance costs through risk management, and underwriters will consider you a better risk if you talk about all the ways that you're proactively managing your risks. And Hub, of course, can also help you do this. So with that, I want to thank you all for listening, and I will turn it back over to Paul, our moderator, to open it up for questions.
Great. Well, thank you so much, Lindsay. And thanks also to Chip and Dave for a really informative conversation. Great deal to unpack there, lots to think about. We really appreciate that. And it is time for the Q&A portion of our program. As I mentioned, this is interactive. The good news is that we've got a little bit more than 20 minutes for audience Q&A. And I know you've all been listening very attentively to these presentations. But if you haven't gotten in your question yet, this is a great time to do it. The first come, first served. And of course, if you prefer to get in touch with our speakers privately, you can do that as well, indicate that on your message. But in the meantime, let's get going and start with some of our audience questions here. So first of all, and I think this is one that could be directed to Chip. And our audience member asked, do some or many or most companies allow deductions for water, leak, and flood detection equipment? And by companies, Chip, I'm assuming that the audience member is referring to insurance carriers. So again, do some, many, or most companies allow deductions for water, leak, and flood detection equipment?
Well, Paul, I think the answer is somewhat in that, and let me explain. I don't think they're going to pay any property owner for that type of equipment. In other words, they're not going to reimburse you for your expenses. But what you are doing is you're showing that you have all those in place, the detection equipment, and they are less likely because of it to have to pay a claim. So the argument is that they should give you a lower rate, a lower premium, because they are less likely to have to pay a claim. So when I say partially, you might get it back somewhat in premium, but you're not going to get the entire amount back. So you might go, maybe 5% off your total premium for having all that in there, on that type of equipment. But no, they're not going to pay it out to you.
Okay, great. Thank you for that. And this one, I think the Chip is also would be a good fit for you. At what point does it make sense to start layering property coverage limits? How about that in this climate?
Well, that's a really good question. And so usually on the larger portfolios, it will make sense in 2021. And when I say a larger portfolio, I mean somewhere over half a billion dollars in replacement cost. And or if it's got catastrophic risk, such as earthquake or flood or windstorm. And what the reason for that is that insurance companies, as I said earlier, they have reinsurance behind the scenes, which is seamless to you as the insured. But what happens is those costs start to go up on them. They want to pass them through. But if you can hold the insurance company, and I'll just pick Travelers, if Travelers is offering 10 million, but half of that's reinsured, maybe you go with them for only 5 million and you'll get a better rate because they don't have to go out and buy all that reinsurance. Well, now you've got to get Chubb or CNA or somebody else to participate alongside with them. So Travelers will say, well, I'll take 25%. And then your broker's got to go to CNA and have them do 25% and so forth. And sometimes that is a premium saving mechanism. Now, the problem with it is all the 4 forms. We've got each carrier doing 25%. Are all the forms magically going to match? No, they're not. So in a claim, that can be bad unless they're using a manuscript form for all four of those different companies agreeing to one policy form. So that's when it makes sense, when you start to see catastrophic risk, large portfolios, or any portfolio that has habitational more than 10 or 15%.
Great, thank you, Chip. And here's our next question, which I think is going to, I'm going to direct it to Dave or Lindsay, whichever one of you would like to take it on. And the audience member wants to know, if my insurance appraisal shows that my cost to reconstruct the building goes up, does that mean my insurance will go up as well?
I'll take this one. It's Dave here. So that's situational dependent, but in most cases, as Chip mentioned in his part of the presentation, there is a direct correlation from the cost per square foot to rebuild the facility and the cost of your insurance. So we would say that in most cases, if your reconstruction estimate goes up, then it is likely that your insurance costs will go up as well. However, we do not want to make the association or deter people from having those appraisals done, because what's dangerous for a property owner is if there is a loss event and there is that gap between the reconstruction value and you're underinsured, that can put you on the hook for significant funds, which can really impact your profitability or your ability to rebuild at all. So having that accurate information is very important to have, but it is also important to know that that can impact the insurance that you do pay on an annual basis.
Now, Paul, it's Chip. I'd like to add to Dave's comments there, is that I do hear that from a lot from real estate owners. One of the things I hear all the time is, okay, I've got a $20 million building of a replacement cost, but it's never going to completely burn. It's, maybe 15%, 20% of it's going to burn. Why would I want to insure this whole thing for $20 million and pay all that premium? And if that's the case, and that's your business decision, you can tell your broker, let's look at a loss limit. Well, what is a loss limit? That means that the insurance company is on the hook for the first 10 million or the first 15 million, and you're self-insuring higher than that. So a lot of people do that. They take a loss limit to save a significant premium on what they think is a best-in-class building that is never going to have a total loss. And you hope they're right when you do it as a broker.
Well, thank you, Chip and Dave. And let me turn to our next audience question here, which has to do with per unit deductibles, and which I think might have come up in one of your presentations. But at any rate, the audience member would like to know: can you explain the benefits of per unit deductibles? Would one of you like to address that issue?
Well, when you say per unit deductibles, per unit is a part of a clause, and I don't want to get too technical, but somebody out there is asking about earthquake, and usually what you do is you have per unit of insurance, and the units can be defined differently in the insurance policies. But for earthquake, especially in catastrophic claims, they're going to take a deductible, and they're going to apply that to the replacement cost at time. Now, if you had a building that had, so you say $1 million and personal property that was $500,000, now you're going to apply your 5 or 10% deductible against that $1.5 million. But let's just say you only had personal property damage in an earthquake, and that's very common. They would say per unit of insurance. A unit is defined as property in the yard, number one. Number two would be personal property. And then number three would be the building. So you could take the per unit of $500,000 of personal property, multiply it against your deductible of 5 or 10%, and that become your deductible. So by having per unit of insurance, what you need to know is by having unit of insurance, you could actually get a lower deductible.
Great, thank you, Chip. Now we have a couple of questions from our audience about multifamily properties. So let's turn to the apartment sector for a few minutes. Our next audience question is, can you talk about insurance for multifamily properties and what you recommend to keep your rates reasonable by possibly requiring tenants to have renter's insurance and not filing claims unless there is something major that has happened? Will this keep rates down? And I guess this is the second part of the same question from the audience member. Also, if you have multiple properties, do you recommend combining them all together in a master insurance policy? Again, multiple multifamily properties. So it's really a two for the price of one here about tenants' renters insurance and also a master insurance policy for multiple multifamily properties.
Well, the first one is a good question about habitational properties, and that's kind of why we're in this mess, is that habitational properties have more claims than any other type of property in real estate. They burn more often and they have more liability issues as well. So by passing the insurance responsibility onto the tenants as much as you can is a benefit. Insurance underwriters want to know that the building owner, the building manager is diligent and that they are collecting certificates of insurance from all the tenants and that there are reasonable limits in the lease. In other words, they don't have to insure just for $15,000. They have to insure for $1 million. So if something happens in their particular apartment, that goes against the tenant's insurance and keeps landlord off of that risk. In the lease, one of the things that they do look for is, are you allowed to have barbecues on the balconies? What types of things, fire alarms are mandated inside the apartments, fire extinguishers and so forth. What are the stairs? Are they well lit? So they're going to ask a lot of questions, and the applications become, almost like going through a home refinance. But they're there for a reason. And if you don't check the box, if you don't answer the question, the computer then goes to the worst default. So some people say, well, hey, if I'm in a habitational apartment building owner and I just don't answer the questions, maybe I'll get a better deal. It's the opposite. The computers now will actually generate the worst possible scenario for you, and that'll be your premium rate. So that's how they operate on the habitational side. As much information as you can and pass the liabilities on to your tenants.
Okay, thank you. And let me turn to another question about the residential sector, and has to do with pets. Our audience member would like to know, does the presence of pets in residential rental properties impact the risk profile? And can I expect a reduction in premium with the absence of pets?
So the answer is no. There is no rating mechanism for pets, cats, dogs, things like that. However, if you allow pit bulls or something that is known to be ferocious, a liability, then, in that case, you're enhancing your liability. But there's not going to be a whole lot on the application or rate relief for barring pets and animals inside of single family dwellings that are leased or apartment buildings.
Thank you. And we're now going to address a question that was, I think, part of the major theme of this program, which is risk management. And our next audience question is, does it make sense from an insurance cost perspective to review and evaluate and update building systems such as security, fire alarm, mass notification to demonstrate risk preparation for fire and security type incidents? So how about that?
It's Dave Barthel here, and the answer to that is yes. All building systems, whether it is a security system, a sprinkler or fire alarm system, or electrical and plumbing systems, all of those systems have life expectancies. And for older buildings in particular, any upgrades to any building system should be communicated to your broker, agent, and thereby the insurance carrier, because that does reflect positively on the building or property owner as having a good risk management plan in place that is also properly financing the building upgrades to keep the building free from losses. So in general, yes, any upgrades are positively reflected and should be communicated to the insurance carrier.
Thank you, Dave. And we have a question about natural disasters. And in particular, our audience member has asked, does a natural disaster, in particular hail damage, impact the rates? So someone like to address that, how the kind of impact that a hail or other natural disaster can have on your insurance rates.
Well, I think Texas is probably the most famous state for hail damage, but you know, for cars, yeah, it's a big deal down in Texas or anywhere. But as far as the buildings go, there are some policies now that you want to be mindful of, where they're having restrictions on redoing the roof from hail. In other words, replacing the roof from hail. So you have to be careful of that. But in normal cases, hail is a covered peril under most property policies. Again, in certain areas, and I'm kind of picking on Texas a little bit, is that they are starting to have some type of exclusions for multiple hail events where, you know, it's just part of the course of nature, and that's not what they want to insure for. They're looking for critical incidences that happen to your property. And hail, if it's part of the natural landscape, like sunshine, or you know, any wear and tear, that's not what they're in business for. So be mindful of that. But in most cases, in most states, hail is a covered peril.
So let's return for a moment to the residential world here. And the question is, for a residential strata building, who would be an appropriate third party to conduct a risk management assessment? So panel, what would you recommend there as far as the kind of third party that would help with a residential risk management assessment?
I think the first question you want to, or first person you want to reach out to is your broker or agent to determine if they have any resources that you can utilize around having a third party conduct an assessment. Hub in particular, we do have a robust group in our risk services division, and we can either provide specific resources to assist or can conduct that ourselves in terms of managing that process. So that would be your first step. Another potential opportunity would be reaching out to your broker. They may have local companies that they work with who independently provide that service. So your first point of contact, my recommendation would be your broker or agent.
Okay, thanks, Dave. And we've got about 5 minutes left in this program. We're going to try to get in as many questions as we can. So this is last call for everybody in our audience. And I've got a follow-up. I believe this is a follow-up from something that we discussed a few minutes ago. And our audience question is, how do we demonstrate to an underwriter that we have robust risk management on a large-scale portfolio?
Sure. Well, one of the things that they're going to look for very quickly, and there's not much you can do about it, but they're going to look at past history on claims. Robust risk management usually yields very little claims, very little risk transfer to insurance companies. And so they're going to reward that. A lot of insurance rates primarily are driven by experience. If you haven't had claims, you know, you're in pretty good shape, better than others. And then you're going to be seeing rate increases just based on market. But if you've had claims, you're going to get penalized for having claims plus market. And so you do want to have, you know, a robust risk management strategy involved. And back to what I've said earlier, you know, things are going to be changing in 2021. You know, tenants are moving out. Tenants are reconfiguring their space. They're subleasing. What used to be women's clothing store is now an Amazon storage unit for boxes. And so you really have to be on top of it as to, well, what does that mean to my property? Well, a storage of Amazon boxes in high racks is a much bigger exposure than women's clothing. So you have a different tenant in there. Did you get a different, you have a different lease, or what did the sublease go through? What about the insurance? Who's in charge of getting the tenant's insurance now that it's a box store and not women's clothing? So those are the things you really want to focus on. But I think, based on what Dave and Lindsay were saying, is that, you really want to have all the questions on the application answered fully. You want to make sure that you don't leave any gaps for the computers to default to raise your rates.
Okay, thank you. And I'm going to ask something here that I'm not 100% sure that will be within the scope of this conversation, but it kind of intrigues me as someone who's covered this area over the years. And so I do want to bring it up with the panel. Our audience member asks, is it common for a lender to allow the borrower a loss limit? How about that?
Well, yeah, that's a good question. And the lenders don't like to see it because their collateral is now at risk. If you're at risk, their collateral's at risk. So lenders are going to shy away from a loss limit where part of the building is not insured. But keep in mind, I've been doing this for a while, and many real estate people say, "Hey, look, this building is not going to go down completely. It's made out of concrete. It's a warehouse, and for the most I could see is it maybe going down to 50%. So you're taking risk. You're going to insure for the first 50%. Lender isn't going to like that. They're not going to like that. They want their collateral fully insured. Matter of fact, lenders, be mindful of this. Lenders want to insure your property for the full amount of the loan. Well, you can't do that because that includes the property value, the real estate value, the land value, and the land isn't going to burn. So a lot of the lenders will push you on a $10 million building where you have a $20 million loan because the land was worth 10. I'm using easy math. They're going to try to force you into a $20 million insurance policy. It's up to your broker and you to fight them back on that because you can't insure land. The land value is not included in an insurance payment. So be mindful of that as well. But no, they're not going to be looking for loss limits. Where a loss limit might benefit and where a lender might say, okay, is if you have a bunch of buildings on a portfolio. So maybe you have 10 locations and so forth, and each of the buildings is worth 5 million. And you might just have one loss limit for all those five properties. And the reason that you would do that is that they're not located next to each other. They're very far distanced, miles apart, or even in different states. And then you could have a loss limit for those 5 properties because they're not going to be subject to one particular claim. They're not going to have one fire that affects all 5 properties. So a loss limit could save you money when you insure your portfolio altogether.
Well, thank you, Chip. And unfortunately, we are just about out of time for today. But first of all, let me thank our audience for some great questions. And in particular, let me give great thanks to Lindsay Shapiro, Dave Barthel, and Chip Stewart of Hub International for your insights on this vital and challenging and timely topic. One more reminder to the audience that we will be emailing you a link to the recording of today's program so you can listen to it again and share it with your colleagues. I hope you'll join us again for another CPE webinar very soon. And until then, thank you for listening and have a great day.